You now have an understanding of the principles, you know about the mental framework. The real thing now is, how do we get into a better position financially? And I think that, again, I'm a big fan of Robert Kiyosaki, and he points out something very simple but very important, which is the difference between the rich and the poor is that the rich know the difference between assets and liabilities, and the poor do not. So what that really translates to is what he calls financial literacy, being able to read a balance statement and understand what those numbers mean. So if we're going to make an impact on your financial picture, then we need to understand what it is that you actually make and where your money is actually going. Understanding how to read a balance statement is improving your financial literacy, improving your financial intelligence. This is really it. I have to warn you though, it is a little bit dry. So I'm going to try and nail it, get it done as quickly as possible and get through all the major important points without losing you. So how much money do you really make? When I ask this question, people tell me their salary. I didn't ask what the salary was, I asked how much you make. What's your net? What's your take home? What's your after-tax earnings? You can make $1 million, but we all know that if you're getting taxed the way that people who don't know sophisticated tax strategies get taxed, you're losing almost half. So I want to know, what is it that you can use to pay yourself the 10% first and to reinvest to make your gold multiply? So let's take a look kind of at the pay stub first. The pay stub is going to lay out line by line what it is that you make. What I want to know is, what is your bottom line? Because in addition to the taxes, you also have some other minor fees that you may not even know about or really understand. So let's examine those. So if you're salaried, you get a regular paycheck. Now you're going to see your gross amount that you're paid, but we're interested in the net, which is the bottom line. That's why that's saying the bottom line. This is after all deductions what it is that you take home. So if you do have that situation where your taxes are already deducted for you, that's, by the way, your biggest expense is taxes, number one, and that's taken right before you even get paid. So in the States, as of 2017, you're paying 6.2% into Social Security. Then you've got 1.45% paid in Medicaid. So that's going to leave you with your effective gross. You're going to be paying out with a couple of benefits as well. In the case of you work at a company, you may have some dental, some health coverage. You're also going to have a retirement plan like a 401k. After all that is taken into account, you're going to be taxed. So you get your federal income tax first of all. In addition to the federal income tax, depending on where it is that you live, you could also be paying a state or a city tax. After all the taxes and after all the deductions are made, you are left with your take-home income. This is going to be your bottom line, your net. In the case where you're not paid a salary, if you're, for instance, a bartender working for tips, and I know how this works, you need to speak with an accountant and make sure you're keeping track of how much taxes you are owed. You have the option to report how much you actually earned, because it's difficult for the government to verify what you've earned in terms of tips. I think honesty is the best policy here. It helps you in a number of ways. You can qualify for more financing if you ever need a loan, which is more important than saving a little bit on taxes. The other thing is, you don't want to raise any red flags. If you start screwing with the IRS, in Canada it's the CRA, you're going to have them hounding you on every little thing down the road. Just be honest, pay what you owe, and live on the rest. In Canada, actually, we have a different system we pay into. So there's unemployment insurance. There's also different kinds of benefits that we can pay into. So there's the Canadian pension plan, and you can also pay into RRSPs. So depending on how that is all structured, you'll need to examine your pay stub line by line. That way you can keep a real record of what's going on. It's important to do this because I don't really consider the deductions that they make for you on your pay stub to account for your real retirement. But I'm a little bit more aggressive with that. If you are okay with counting that as your retirement, then fine. But I did encourage investing your gold to make it multiply. So I would consider not using those as any sort of plan of retirement. It may not pan out the way that you want. It may, but it's better to plan, again, expect the unexpected, plan ahead, and be a little bit more conservative with that. Okay, so now you have an idea of what's really going on with your pay stub. Why did we go through all this? Well, by now you probably think of me as a little bit of a critical thinker. I want you to take a critical eye and re-examine that pay stub and ask some very simple questions. Like number one, if I'm taxed on anything, is there any way I can get any rebate? Am I eligible for being able to write off anything? For instance, can you write off your cell phone or your shoes or other clothes that you have to buy, your gas or mileage on your car in order to go to work? Is that something that you can write off? Maybe you can, maybe you can't. But ask that critical question. Another good question is, I mean, I do have to pay into these retirement accounts, but is there any way that maybe I can opt out of the company-sanctioned retirement payment plans? Can I choose my own? Or is there any way, if you can't, to redirect what you've paid into your retirement savings? So as an example, you can purchase real estate by funneling your retirement savings through a trust into a real estate transaction with someone who's at arm's length. And this is, again, complicated stuff, but this is just an example to help you thinking. You want to take a critical eye to it because you don't want to just accept those as losses. I said that before, that they may just be thought of as losses, but maybe you can use them again in a real intentional way and actually see results right away rather than hoping that they'll be there when you need them. More importantly, are you eligible for any incentives or rebates based on your income level? Can you get any energy savings? Can you get anything back because you made it below a certain bracket and somehow there's a government program for people in your situation? You never know. Just take a critical eye to this pay stub. Re-examine these expenses because you may be able to pull them out and use them in ways that you never thought possible. And again, helps to have an accountant by your side to explain all this stuff. So if you don't have an accountant by now, consider looking into one, interview a couple, and see how they can help you figure out how to optimize all of these expenses that affect your bottom line. Importantly, you may be thinking that you don't need an accountant because they cost $100 or whatever. Believe me, good accountants are worth their weight in gold. They think of it this way. You can't help your health by saving money by not going to a doctor. I mean, they made it their life's work to know how to help you. And you definitely don't want to cheap out there with your health or your taxes. So again, it's important to have the right kind of accountant. Interview people and find someone that you believe will help you achieve your goals. And don't skimp out on that because that is an investment. If it's not to find out all these little possible ways to earn a little bit more on your pay stub, then definitely when it comes time to pay the tax man, they will help you make sure that you're not overpaying or that you get the rebates that you are entitled to. Okay, so you've got your pay stub figured out. You know what you're really making after all the necessary deductions or perhaps unnecessary. You'll have to find out. Now you've got your income that you're working with. Okay, but the thing is, your income is one side of the picture, and the other side of the picture, obviously, would be your expenses. This leads me actually into a larger picture. And going back to what I said a moment ago about Robert Kiyosaki's whole thing about financial literacy, you need to learn how to read a balance statement. And it's not as obvious as you may think. It took me a while to sort of figure out how the numbers all relate to one another, but keep everything, it may help to write them out by hand or you can get a sheet online. Keep everything separated in the following columns. You have your income, you have your expenses, you have your assets, and you have your liabilities. Keep these broken up. Don't mingle them together because you need to see how each of them is affecting the other and what your financial picture looks like in terms of the flow of money rather than just a lump sum of money and a negative sum of money or a positive. So after going through that visual example of the balance statement, you can see that the difference between the rich and the poor is the flow of cash. You see that for the rich, they only use their income to feed liabilities that allow them to get assets that pay for their expenses, leaving leftover income to go back into their income, and it spirals out of control and they get richer and richer. The poor, by contrast, have an income coming out from some unknown source, perhaps a job, but it goes right into their expenses and to their liabilities, and it very rarely goes into assets. It's this difference in habit and also the difference in knowing what a real asset is and what a real liability is that separates the two. And this is really important because it fleshes out the importance of the third principle from the richest man in Babylon, making your gold multiply. In order to do this successfully, you need to be able to first read a balance statement and take away from the behavior patterns of what the rich do, which is feeding into those assets to grow their income levels. That's a visual example of the principle, which is kind of intangible. So that's the real importance to take away from that whole spreadsheet example. Another takeaway would be actually, you'll notice that the rich feed into liabilities, but certain kinds of liabilities, the liabilities that get them the assets. This is different from liabilities like a sports car and getting it leased. You never, ever finance luxuries. You never get loans on things that only go down in value and you have no way of recouping the funds if you need to sell. That is a very dangerous habit, and again, one of the major differences between the rich and the poor. What the rich will do in those cases is they will acquire a liability to pay for an asset that will produce an income to pay for those liabilities. So in other words, they're one step ahead. They don't use their cash to buy something nice like a Ferrari. They buy an apartment building that will finance the Jaguar or whatever car, the Lamborghini that they want to get. So that's a very important difference. Don't do that. Don't ever finance luxuries, but pay them out if you need to have them. So I want to wrap up this section of the whole lesson plan here and talk about something that's very important. You went through the exercise, you understand how the numbers work, you know how to read a balance sheet. What's really important now is to ask, how will you retire? I read an interesting survey conducted by different banks and interviewing different Canadians. 90% of Canadians apparently said that they plan to retire by depending on the government, or CPP. 59% said that they were getting a part-time job. 40% said they relied on inheritance. And something like 1/3 of the population said that they relied on winning the lottery. I mean, this is just such devastating news to me, and it really hits home. And unfortunately, I don't have the statistics for other countries, but the takeaway really is these are not just stupid people that have bad ideas. This is the way that we have set our people up in the country, is to depend on the government or to depend on inheritance. Selling a home and retiring on that. This is a very bad plan for retirement. And what I want you to take away from this is to really ask, based on what you know about the numbers now, what is your plan to retire? How are you going to be able to use what you've just learned to prevent relying on something like winning the lottery, which, if that's what your plan is, I really hope you change your mind after you hear me telling you that's not so great. But if you remember this one thing, above all, it's not about how much money you make. It's about how much you keep. It's about how you use it. If you have the right kind of knowledge, if you have the financial literacy, first of all, and you have the right plan based on the right principles, and you don't waver, if you commit, you will attain. It's a law, just like gravity. It's unavoidable. Just by following these, trust me, over time you'll be in a totally different time and place. Don't rely on winning the lottery. Make it a commitment and take care of yourself and your loved ones.